removing risk to adjust delta. So when we have these big, crazy moves to the upside, and we've seen this weird couple of days where we've been up 100, down 100, up 100, down 100, up 100 intraday, down 100 by the end of the day. Just absolute craziness.
Whiplash.
Yeah, pure whiplash. So when you see these big moves, and I feel like in the E-minis, like if you see 100-point rally, that's a move I'm talking about here. I'm not talking about a 30-point move. I'm not talking about a 40-point move. I'm talking about a 100-point move to the upside, maybe over a 100-point move to the downside.
Outside the expected.
Exactly.
And and actually, just because you mentioned that, I'm going to put this out there because if you remember on Friday when we were looking at the VIX at about 32, 33-ish, I had mentioned that it's roughly a 2% expected move on a day-to-day basis, and that's in either direction, plus or minus, would be within volatility's projection for, price action. Today, the E-minis have moved about 2.5%. So, although it's a huge move and it is outside the expected, it's not like we're exploding outside the expected move. So it is that big move or in either direction is relative to what volatility is projecting. I would certainly say that, volatility being in the 30 handle is a rare occurrence. And when you see realized volatility come in greater than that, that is definitely notable. So I would definitely say this is a big move.
Yes.
But it's not like the VIX was at 16 and we woke up to a 2.5% move where it's 2 or 3 or 4 times the expected move for the day. We're basically at the expected move a little bit beyond that. But with the VIX at a 32 or 33, that is a high watermark to hit in terms of realized volatility.
Yeah.
We're hitting it.
Yeah. Still exceeding the expected move when the VIX is near the highs of the last couple months.
That's a rare occurrence.
Yeah. But it is good to put context around it in that fashion. So you understand like how big is this move really relative to what's implied. But nonetheless, when we have these big melt up and meltdown days, instead of adding new positions and adding more risk into a really choppy market, we typically look to remove positions where we can. So I woke up this morning. That was my first thought. My first thought was, where are these bullish positions that I can take off for winners or scratches to reduce my positive delta in my portfolio? This brings the portfolio delta closer to zero if I'm doing this, because if I have winners that I'm able to take off the table into a big rally, if I'm taking off those bullish positions, and this morning I took off 4 positions, and all 4 of them were, one was a call diagonal spread in Amazon, the one I followed you in.
Yeah, I've debated closing that all day today. I think I might just hold it and hold some risk, but yeah.
That's fair. So I closed that, and then I closed 3 short puts. So all 4 of those positions are bullish positions, and I've now removed those. So whatever my portfolio delta was before, I thought it was 30. It definitely wasn't. But let's say it was 180 positive bullish deltas. When I remove those 4 positions, it naturally brings my portfolio delta down closer to zero because I no longer have those 4 positions that add bullish delta to my portfolio. So I'm bringing my portfolio delta closer to zero against the move that I'm seeing today, and I'm taking off risk. And I think that's the big difference between throwing on bearish positions right now. You're adding risk to adjust delta. Taking off bullish positions that are winners or scratches, you are removing bullish delta, which also brings your delta down, in this case closer to zero, but you're doing so by removing risk. And I think that's one big thing that I think is overlooked, especially on market days like this, where it's just a melt up. Like you can't really categorize it any other way. Whether it's people buying in, whether it's short covering, whether it's combination of both, it doesn't matter. This is a big rally relative to what we've seen over the past couple of months.
Yeah. And I think this just goes to, what we were talking about before we got into the slides of just having limited capital. And everybody has capital limitations to some extent. Some are much further away in their normal trading, and some are like ours, where every day you kind of have to keep in check your capital usage and how that capital is allocated to certain positions. But, one of the ways that you can, get deltas in smaller sized accounts is by closing out of these positions that have come in, that have gone in your favor, that hold some sort of delta. From a transaction standpoint, if you think about all of your trades today, if you didn't have them on, right, you're closing out of a long call call diagonal spread is synthetically selling a call spread, right? You're selling a call spread to close that position. You're getting some short delta. The puts that you were short, the transaction today, the action today is buying puts into a move higher, right? So you're closing out of these positions. And if you think about that sort of dynamic of, okay, I sell the put and the stock goes up, that's great. I could still get more value out of this put. But by doing that transaction, closing that position, you're synthetically buying that put, that risk. If the stock goes down, that value add is still on the table that you've realized. So this sort of adjustment and kind of managing positions, it not only books winning positions, but it gets you deltas, opposite deltas to the move that we're seeing today. It's getting you short deltas into what are higher prices today.
Yep. And again, one last time, you're not adding risk, you're reducing it. So tomorrow, if we see a 50-point sell-off or a 40-point sell-off or whatever, my portfolio is going to be way better off than if I kept the positions on. So another implication of doing this is that you believe that in the near term, you're going to see some sort of reversal, which I certainly do, given the nature of what we've seen over the past 4 trading days.
Yeah. Well, and you could quantify and just say the VIX is still at 30. Mm-hmm. So if we're down 2% tomorrow, that's within what the market projects. If we reverse the entire move today, that would be within implied expectations.
Right. So this is just a year-long graph of SPX, and this isn't to tell you that if there's big rallies, there's going to be big sell-offs, or if there are big sell-offs, there's going to be big rallies. But you can just clearly see that when there are big moves in one direction, you typically see some sort of opposite move. And I've kind of highlighted some examples here. So like in the beginning of January, we went from 4,600 down to 42. And then within 5 trading days, we were back up to 44. So 200-point reversal there. Then there's examples everywhere, but you had in March, you go from 41 to 45. And then a couple weeks later, you go from 45 back down to 42. So you're seeing hundreds plural points moves in many different examples here. So these are the things that we're talking about. Like when we see big chunks up and we see big chunks down, that's when we typically take a stance the other way. And in the case of removing risk, it doesn't really hurt you. You're taking off risk. Yeah. It's not like you're adding risk into this and you're like, well, this is going to happen tomorrow. It's a totally different thought. It's the fact that we're removing risk to adjust our delta in a synthetically contrarian way. And if we are right, we're going to be better off than if we left the position on. So, and especially the last couple of days where we saw the intraday reversal, we've seen the 100-point, 100-point sell-off, 100-point rally, the rally that turned into a sell-off, the sell-off that turned into a rally. We've seen it all in the past 4 days. And if you've been making these adjustments, you've been basically painting tops and painting bottoms, which is not something you can expect all the time, but this is why we go about doing something like this.